Okay, let's dive into this. Welcome to today's explainer. We're skipping the usual agenda today and jumping straight into the deep end because we're tackling a seriously fantastic financial strategy that could potentially save you thousands of dollars. We're talking about carry forward super contributions, specifically how you can use 5 years of unused caps to your absolute advantage. Seriously, if you've ever had a surprisingly good financial year and then completely dreaded the upcoming tax time, well, this explainer is built exactly for you.
So let me ask you, what actually happens to your tax bill when your income suddenly spikes? Just imagine it for a second. You've worked incredibly hard, right? Maybe you finally sell an investment property. You get a redundancy payout. Maybe you score a massive bonus at work, or your small business just has an absolute bumper year. You've achieved this major financial win. But then the reality sets in. That massive one-off income spike, it pushes you straight into a much higher tax bracket for that single year. And suddenly you end up having to hand a huge chunk of your hard-earned wins straight over to the tax man. It's incredibly frustrating, isn't it?
Now, check out this stark contrast. This exact gap you're looking at is the entire value proposition of today's explainer. That one-off income spike we just talked about? Well, it can be taxed at your highest marginal rate, which could be up to 39%. But money contributed to your superannuation is taxed at just 15%. That difference, bridging that huge gap between 39% and 15%, is where the magic happens. Honestly, it's one of the very few strategies out there that can legitimately knock 5 figures off a one-off tax bill and do it completely within the rules. So you're probably wondering, how do we actually do this? The answer is carry forward super contributions. This is an absolutely brilliant ATO-approved strategy that basically allows you to use your unused concessional cap amounts from the past 5 years and apply them to offset your current taxable income. Think of it like a giant reservoir of tax-deductible space that you've just been unknowingly building up over the last half-decade. If you missed out on maximizing your super contributions in those early years, you're now allowed to catch up. To really understand how this works, we kind of need to look at the baseline. For the 2026/27 income year, this standard concessional contribution cap is $32,500. So that's the normal limit you can contribute at that sweet 15% tax rate. But here is the absolute best part. Any unused carry-forward space you have sitting around from previous years stacks directly on top of this $32,500 limit. You aren't just limited to this year's cap. You get this year's cap plus whatever you just haven't used from the last 5 years. All right, let's move on to Section 1, the eligibility rules. Who can use carry forward? Now, whether you're an employee using salary sacrifice or you're a sole trader, this strategy is totally available to you. But there's one massive hurdle you have to clear. Your total superannuation balance must have been strictly under $500,000. And listen, timing is literally everything here. That balance is measured at the previous 30 June. So say you want to make a carry-forward contribution in the 2026-27 financial year. Your balance had to be strictly under $500,000 on the 30th of June, 2026. And you have to pass this balance test in each and every year you want to utilize the strategy. No exceptions. Take a look at how this 5-year timeline works. Unused caps roll forward for 5 years, and your oldest amounts are always used up first. But, and this is crucial, they do not last forever. They expire. An unused cap amount originating from, say, the 2021-22 financial year is currently sitting right at the edge of the cliff. It absolutely must be used by the end of the 2026-27 year, or it simply falls off the timeline and vanishes entirely. It's very much a use it or lose it scenario for that oldest year. Okay, so how do you know what your unused caps actually are? Please, whatever you do not try to guess this or calculate it yourself from a shoebox of old pay slips. The ATO actually tracks all of this for you. You just need to follow a few simple steps. First, log into your MyGov account. Click through to ATO Online Services. Go to the Super tab, then click Information. And finally, just select Carry Forward Concessional Contributions. Boom. Right there on your screen, you'll see the exact unused figure listed for every single eligible year. Absolutely no complex math required, which is a massive relief, right? Because trying to do manual tax calculations from old documents is a headache literally nobody needs. Now, before we look at a real-world example, I do need to highlight a really crucial piece of administrative housekeeping. If you're making personal contributions directly from your bank account so you can claim this deduction, the standard deduction rules absolutely still apply. You can't just transfer the money into your super and call it a day. No way. You must lodge a formal notice of intent to claim a deduction form with your super fund. And critically, you have to receive their written acknowledgement before you actually lodge your tax return. Don't skip that step.
Okay, on to Section 2, Lena's tax saving strategy, a practical example.
Let's just slow down for a minute and actually see how this math comes together in the real world. Meet Lena. She's a sole trader. In 2026-27, she sells an investment property and realizes a taxable capital gain of $90,000. And by the way, that's even after the standard CGT discount. Now, normally, that is a massive tax headache. But let's look at her numbers. Her super balance is $310,000, so she easily passes that $500,000 balance test. Awesome. She logs into MyGov and sees she has $38,000 of unused caps sitting there from the past 5 years. So, Lena contributes that full $38,000 to her super and claims the deduction. And this brilliantly illustrates the power of the strategy. Instead of paying up to 39% on that $38,000 slice of her property gain, she shifts it right into the super environment where it's taxed at just 15%. By doing this, she effectively saves roughly $9,000 in tax while simultaneously giving her retirement savings a massive boost. It's a total win-win.
Finally, Section 3, avoiding costly mistakes.
Of course, with any tax strategy, the devil is always in the details, right? While Lena's example shows the incredible upside, here is your quick checklist of what not to do. First up, assuming eligibility. Remember, the test is strictly under $500,000. If your balance at the previous 30 June was exactly $500,000, or honestly, even one single dollar over, the strategy is entirely off the table for that year. Second, letting old caps expire. Remember our timeline? If you have 2021-22 unused amounts, they just disappear after 2026-27. Always use those oldest ones first. And finally, contributing more than you can actually deduct. You cannot use a super contribution deduction to create a tax loss for yourself. You should really only match your contribution to offset your taxable income. Keep it clean. I really want to leave you with this fantastic summary quote from Oz Ledger. Carry forward contributions let you shelter a big chunk of a one-off income spike inside super at 15% tax instead. It is such a simple but profoundly impactful concept for wealth building. So, based on everything we've walked through today, here is my final question to you. Have you checked your MyGov account lately? And are you accidentally leaving thousands of dollars in unused tax-saving caps to just expire? Think about it. Thanks for joining me for this explainer, and I will catch you next time.